Welcome back to the channel. If you're new here, please subscribe and like the video. If you have any suggestions or topics you'd like me to make a video on, feel free to comment below. I hope these videos are helping you. Let's get started. Capital preservation comes before profit. Most traders enter the market dreaming of profit, but they stay only if they learn how to protect what they already have. Money made in the market is never truly yours until you have proven you can keep it. The crowd is obsessed with gains, percentages, and returns, yet history shows that fortunes are not lost in one bad trade, but through a careless attitude toward risk. A trader who survives bad periods will always have another chance to profit, while a trader who ignores preservation will eventually be forced out, no matter how talented he may be. The market offers endless opportunities, but capital is limited. Once it is damaged beyond repair, no strategy, no insight, and no confidence can bring it back. This is why preservation is not a defensive mindset. It is an offensive advantage. When you protect your capital, you protect your ability to think clearly. Fear enters when losses grow too large, and fear leads to impulsive decisions. A preserved account allows patience, and patience is the most undervalued edge in trading. Losses are unavoidable, but destruction is not. The professional accepts small losses willingly, because he understands that they are the cost of staying in the game. He never allows a single idea to threaten his future. Every position is sized with respect for uncertainty. The market does not reward courage without control. It rewards those who live to trade another day. Many traders believe that focusing on preservation limits their growth. In reality, it accelerates it. By avoiding large drawdowns, a trader benefits from compounding. Recovering from a small loss requires discipline. Recovering from a large loss requires luck. Luck has no place in a serious trading operation. Preservation removes the need for hope and replaces it with process. When capital is protected, confidence becomes steady instead of emotional. Decisions are made based on rules, not desperation. The trader no longer feels pressure to trade every move or chase every rally. He waits for conditions that justify risk because he knows his survival does not depend on constant action. This mindset separates the professional from the amateur more clearly than any indicator ever could. In the end, profit is a byproduct, not the foundation. The foundation is staying solvent, calm, and prepared while others exhaust themselves. Markets will rise and fall. Systems will go through winning and losing periods, but the trader who prioritizes preservation remains standing when the cycle turns, and when opportunity finally aligns with preparation. It is always the survivor who is positioned to benefit. Risk is defined before entry. Every trade begins long before the order is placed. The moment a trader clicks buy or sell without first knowing how much he can lose, he has already surrendered control. Defining risk before entry is not a technical rule. It is a mental discipline that forces clarity in an uncertain environment. The market can do anything, but the trader must know exactly what he is willing to accept if he is wrong. Uncertainty is the only certainty in trading. No setup, no matter how clean it looks, guarantees success. By defining risk in advance, the trader removes emotion from the decision-making process. He is no longer reacting to price, he is executing a plan. This distinction is critical because reaction is driven by fear and hope, while execution is driven by preparation. When risk is defined beforehand, losses lose their power. A loss that was expected and accepted does not shock the mind. It does not trigger revenge, hesitation, or overconfidence. It becomes a business expense, nothing more. The trader exits without argument because the market has simply delivered information that contradicts his idea. There is no shame in being wrong when the cost of being wrong was planned. Many traders focus on how much they can make from a trade, but professionals focus on how much they can lose. Reward is meaningless without context. A potential gain may look attractive, but if the risk is undefined or excessive, the trade is already flawed. By setting risk first, the trader filters out low-quality opportunities and reserves capital for situations that truly matter. Predefined risk also creates consistency. When every trade carries a controlled and similar level of exposure, results become measurable and improvable. Without this structure, performance becomes random, and learning becomes impossible. One large loss can erase months of discipline, not because the market was unfair, but because risk was ignored. Defining risk before entry also protects the trader from himself. In the heat of the moment, emotions distort judgment. Fear encourages early exits, and greed encourages stubbornness. A predetermined exit level removes debate. The decision has already been made in a calm state, not under pressure. This is where professionalism shows itself. Over time, this habit reshapes the trader's mindset. He stops thinking in terms of winning and losing and starts thinking in terms of execution. Each trade becomes one of many, not a personal test of intelligence or worth. The system, not the outcome of a single trade, becomes the focus. A trader who defines risk before entry may miss some opportunities, but he will never miss the one that matters most, the opportunity to stay in the game. And in trading, staying in the game is the only path to long-term success. Discipline outweighs prediction. The desire to predict is natural. Human nature seeks certainty, especially in an environment as uncertain as the market. Many traders believe that if they can just improve their analysis, sharpen their forecasts, or find better information, consistency will follow. But markets are not defeated by superior prediction. They are navigated through superior discipline. The trader who waits for perfect certainty will wait forever, while the disciplined trader acts decisively within defined rules. Prediction creates attachment. Once a trader forms an opinion, he begins to defend it, even when price disagrees. Discipline, on the other hand, creates flexibility. It allows the trader to change his stance without emotional cost. When rules are followed, the trader is never wrong. He is either in a trade or out of one, simply responding to what the market is doing, not what he believes it should do. A disciplined trader understands that being right is not the goal. Being consistent is. The market can make any opinion look foolish in the short term. What matters is not accuracy, but behavior. One good prediction followed by poor discipline leads to ruin, while average predictions executed with strict discipline can produce steady results over time. This is a truth many learn too late. Discipline shows itself most clearly during winning periods. Success tempts traders to relax their rules, increase size impulsively, or take trades outside their system. This is when discipline is tested, and this is when most damage occurs. The market does not punish ignorance as harshly as it punishes arrogance. A disciplined trader treats winning streaks with the same caution as losing ones. Rules exist to remove decision-making under pressure. Without them, every tick becomes a debate. Should I exit now? Should I hold longer? Should I add more? These questions exhaust the mind and invite emotional errors. Discipline answers these questions in advance. It replaces stress with structure and hesitation with clarity. Prediction encourages overtrading. Discipline encourages selectivity. The trader stops chasing every move and waits for situations that meet his criteria. This waiting is not passive, it is intentional. It reflects respect for the market and confidence in one's process. The disciplined trader knows that missing a trade is harmless, but breaking rules is expensive. Over time, discipline builds trust, not in the market, but in oneself. The trader no longer measures success by individual outcomes, but by the quality of execution. Losses no longer feel personal, and gains no longer inflate the ego. Everything becomes part of a larger process. In the end, the market rewards those who can control themselves more than those who try to control price. Discipline turns uncertainty into a manageable environment, while prediction turns it into a battlefield. And in trading, the calm, disciplined operator outlasts the brilliant predictor every time. Patience is a strategic advantage. Most losses in trading do not come from bad analysis, but from bad timing driven by impatience. The market spends much of its time doing nothing of importance, yet traders feel compelled to act as if opportunity disappears the moment they step aside. This constant need for action is not a strategy, it is a weakness. Patience, when practiced deliberately, becomes a powerful edge that most market participants never develop. A patient trader understands that waiting is part of the job. He does not measure productivity by the number of trades taken, but by the quality of decisions made. By allowing price to confirm conditions instead of anticipating them, he avoids unnecessary exposure. This restraint protects both capital and confidence, which are easily damaged by forced trades. Impatience often disguises itself as confidence. Traders convince themselves they see something others do not. when in reality they are simply uncomfortable waiting. The market quickly exposes this illusion. Entering too early, exiting too late, or trading without confirmation are all symptoms of impatience. Patience eliminates these errors by enforcing timing that aligns with structure, not emotion. When patience becomes habitual, the trader begins to see the market differently. Noise loses its influence. Small fluctuations no longer demand attention. Only meaningful movements matter. This shift in perspective reduces stress and sharpens focus. The trader is no longer reacting to every price change. He is observing, assessing, and choosing when to participate. Patience also creates emotional balance. Waiting through periods of inactivity tests discipline, but it prevents burnout and overconfidence. The trader who is comfortable doing nothing is immune to the market's most common traps. He does not chase strength or panic at weakness. He waits for price to come to his level on his terms. Over time, patience compounds its benefits. Fewer trades mean fewer mistakes. Fewer mistakes mean smoother equity curves. Smoother equity curves mean clearer thinking. Clear thinking leads to better execution, which reinforces patience further. This cycle is difficult to break once established, and it separates seasoned professionals from restless beginners. The market always offers another opportunity. Those who rush believe this is not true. Those who wait know it is. Patience allows the trader to conserve energy, capital, and emotional stability for moments that truly matter. It turns waiting into an active decision rather than a passive delay. In the end, patience does not slow progress. It accelerates it by removing unnecessary damage. The trader who masters patience gains something rare in the market, the ability to act without urgency and to wait without fear. And that ability, quietly and consistently, becomes a decisive strategic advantage. Losses are part of the business. The moment a trader believes losses should not happen, he places himself in conflict with reality. The market does not offer certainty, and it does not reward entitlement. Losses are not a sign of failure. They are evidence of participation. The trader who avoids losses entirely is not skilled. He is inactive. Understanding this truth early is what allows a trader to last long enough to succeed. Every trade is a probability, not a promise. When a position is taken, the outcome is unknown. Accepting this uncertainty is what transforms losses from emotional events into operational costs. Just as a business pays rent or salaries, a trader pays losses to remain in operation. Resisting this fact only increases emotional pain and leads to poor decisions. The danger does not lie in losing trades, but in how losses are handled. Traders who fear losses hesitate, interfere, and abandon rules. Traders who deny losses hold on to bad positions, hoping the market will rescue them. Both behaviors stem from the same misunderstanding, the belief that a loss reflects personal failure. In reality, a controlled loss reflects discipline. A professional trader does not try to avoid losses. He tries to control them. He knows that small losses are acceptable, expected, and necessary. They provide information. They confirm that risk was defined correctly and that discipline was respected. Large losses, on the other hand, usually signal a breakdown in process, not bad luck. Losses also serve an important psychological function. They keep the trader humble. They prevent overconfidence and remind him that the market is always larger than any single opinion. Without losses, complacency sets in, and complacency leads to careless risk-taking. In this way, losses act as a corrective force, keeping behavior aligned with reality. When losses are accepted as part of the business, emotional recovery becomes faster. The trader no longer seeks revenge or validation. He reviews the trade, checks whether the rules were followed, and moves on. There is no need to win back money immediately because there is no sense of having been wronged. The market owes nothing. Over time, this mindset changes everything. Losses stop feeling heavy. They stop defining confidence. The trader becomes outcome independent, focused on execution rather than results. This emotional neutrality is rare, but it is essential. Without it, consistency is impossible. The market does not reward those who avoid discomfort. It rewards those who manage it. Losses are uncomfortable, but they are also unavoidable. By accepting them fully, the trader removes their power. They become routine, manageable, and temporary. In the long run, profits come not from avoiding losses, but from allowing them to remain small while gains are allowed to grow. This balance cannot exist without acceptance. Losses are not the enemy of success. Refusing to accept them is that consistency creates longevity. Success in trading is rarely the result of brilliance applied once. It is the result of correct behavior repeated over time. Many traders experience short periods of success, only to disappear when conditions change. What separates those who remain from those who fade is not intelligence or opportunity, but consistency. Without it, even the best ideas lose their power. Consistency begins with repeating the same process regardless of outcome. A trader who changes behavior after every win or loss never allows probability to work in his favor. Markets reward patterns of disciplined action, not emotional reactions. When rules are followed trade after trade, results become stable enough to evaluate and improve. Inconsistency often comes from chasing recent performance. After wins, traders loosen rules. After losses, they tighten them excessively or abandon them entirely. This constant adjustment creates chaos. A consistent trader understands that individual outcomes are irrelevant. What matters is whether the system was executed as designed. This mindset protects both confidence and capital. Longevity in trading depends on surviving unfavorable periods. No system performs well all the time. Drawdowns are inevitable. Consistency allows the trader to endure these phases without self-sabotage. By maintaining the same position sizing, risk limits, and decision-making criteria, damage is contained until conditions improve. Consistency also reduces psychological fatigue. When decisions are made the same way each time, mental energy is conserved. There is no constant debate, no emotional second-guessing. This clarity leads to better focus and faster recovery from mistakes. Over time, trading becomes less stressful and more controlled. A consistent approach allows learning to occur. Without consistency, it is impossible to Now what works and what does not. Random behavior produces random results. Structured repetition produces meaningful feedback. This feedback is what allows gradual refinement without destabilizing the system. Longevity is not about avoiding mistakes, but about limiting their impact. Consistency ensures that no single mistake becomes fatal. It keeps losses proportional and prevents emotional spirals. The trader remains objective because his behavior is guided by rules, not moods. Over the long term, consistency builds trust, not in the market, but in the process. This trust creates confidence that is calm, not aggressive. The trader no longer feels urgency to prove himself. He understands that time and repetition are allies, not enemies. Markets will always change, but disciplined behavior can remain stable. That stability is what allows a trader to adapt without breaking. In the end, longevity is earned not through occasional excellence, but through steady, repeatable discipline. Consistency does not guarantee success, but without it, survival is impossible.